A very good morning and warm welcome once again to Money Sense. I'm Simon Caudry and I have the pleasure of hosting this morning's show and welcoming back to the studio the erudite and potentially entertainingly irascible, depending on his mood, Anthony Travers. Good morning, Tony.
Morning, Simon. Thank you for inviting me.
So how are you this morning?
Well, you find me in the very springtime of my senility.
Okay. Springtime. I didn't realise you were that old. What's going on?
Well, older, I think, as my grandmother would have said, is always better, unless she would usually add, "You're a banana."
Fair enough. Well, let's try not to slip on any banana skins this morning,
Right.
And see where we get to. Well, today's show, then, is going to delve into the subject of Cayman's place in the world. We've had guests on the show before who have extolled Cayman's attractions, as well as some who have critiqued certain elements of our financial arrangements. With the EU having recently adopted a resolution to imminently place Cayman on a blacklist of non-cooperative jurisdictions, we thought it was time to assess where Cayman stands today. You're no stranger to our listeners, Tony. Your writings are oft discussed amongst the community here, and I think it's fair to say you have a somewhat cynical attitude towards the European Parliament and its motives. So today's discussion, I hope, is full of vim and vigour. Let us begin, if we can then, Tony, with where are we and why the devil is Cayman once again being blacklisted?
Well, where we are is exactly where, if you had read some of my earlier writings, particularly an article I wrote entitled "The Cayman Islands Should Regard the EU as a Dead Zone," some 3 or 4 years ago, were exactly where I predicted we would be. And it's not just the EU, it's their cohorts, the OECD, their underlings, the FATF. But if you look at the history now, you see a very, very clear pattern of conduct. We are either threatened with a blacklist, on a blacklist, off a blacklist, but on a grey list. But at no time are we vindicated in any way in the eyes of the EU. And the logical conclusion to all of that is that the European Union and the OECD, the FATF, have in mind the termination of financial services in the Cayman Islands. Now, you quite correctly mentioned the latest, it's actually European Union Parliament, not the EU Commission, resolution of January the 21st, 2021, which is extraordinary. I'll say the European Union not being a democratic body, the European Union Parliament resolution is not binding on the European Commission, so I should make that point. But nevertheless, I think one of your earlier guests said there are some people in Europe who regard the Cayman Islands as being on a permanent blacklist. Well, it's not just one person. The European Union Parliament voted 580 to 60 to put the Cayman Islands back on a blacklist. And now at least they come clean. And now at least they tell the truth, finally. The reason they say that we should be on a blacklist is because we have a zero rate of tax. And that is, of course, what they've been attacking from day one. I mean, you may say, you describe me as being cynical. Actually, I would say, as a result of that revelation in the European Union Parliament, I've simply been entirely accurate. So it's the zero rate of tax that they're attacking.
So is the perspective you're sharing there that actually we finally got to a state of honesty? In that historically there's been decades where there's been excuses or reasons why we've been placed on a blacklist, but actually those were covering up, subterfuge for the real reason.
You could absolutely say covering up or subterfuge. The interesting thing about the EU attack on the Cayman Islands over a great number of years is that at no time have they articulated the reasons why we should be on a blacklist. They talk, Pierre Moscovici, the previous EU tax commissioner, Ludmila Petkova, the current chair of the European Code of Conduct group, both not incidentally dyed-in-the-wool communists. In fact, if I digress for a moment, Moscovici was not merely a communist, he was a French Trotskyite, the worst sort of communist, at least until the events of last night, possibly. But they were very, very skilled in the art of economic warfare. But at no time in their allegations of tax evasion or tax avoidance in the Cayman Islands have they ever established how the Cayman Islands is supposed to be involved in tax avoidance or tax evasion. And the fact of it is, of course, they haven't, because they can't because we're not. We're not a double tax treaty jurisdiction.
And what you mean when you say by that, what you mean by that is that's a route by which companies have used, say, Ireland or Luxembourg as a favourable jurisdiction to actually reduce their taxes that they should actually be paying.
Correct. The tax avoidance must necessarily occur by way of a double tax treaty mechanism. Yes, the Netherlands, in addition to Ireland and Luxembourg, as you mentioned, have been the jurisdictions where the tax is avoided. There are now some very interesting papers being written by European Union think tanks which firmly state that to be the case. But we're left in this position of allegations having been made, in accordance with the vogue in PR at the moment. If you want to denigrate your target, you accuse them of doing exactly what it is that you are wrongdoing. And that's what's been occurring. But the fact of it is that the European Union definition of tax avoidance is a lot like everyone else's definition of snogging in public. It's a very bad thing to be seen to be doing unless you're doing it yourself.
But not illegal.
Not illegal.
Except in certain countries, arguably.
Possibly.
May not go into that.
Well, you've got to be careful.
So there is a point, though, that this has been going on. Well, Cayman's not the only zero tax jurisdiction, but Cayman is one of the few that's constantly on the blacklist.
Yes, because it's the most successful. If you look at the most recent numbers from the Monetary Authority, which now incorporate the 14,600 private funds of the 34,000, so slightly less than half, about 40% of the private funds have now been regulated under the wholly unnecessary private funds law, which point we may come on to later. You find that gross assets under management in the Cayman Islands are up to nearly $9 trillion. Now, that is all in and net around $4.9 trillion. Now that is actually more than Dublin and Luxembourg put together in the alternative investment fund space. Now, admittedly, of course, Luxembourg and Dublin have something called UCITS, which is a retail European Union product, which we don't mess with. It's out of scope for the Cayman Islands. But when you look at the dollar value and you analyze the European Union's paranoia about capital flows, which they need to have domesticated in the European Union to support their increasing need for tax revenues, and they see these things as inextricably entwined. They see capital as a source of taxation. Then you see why they regard the Cayman Islands as the primary threat.
Do you think it's ignorance, jealousy, or some other word?
I don't think anybody could be that stupid. Certainly not Moscovici, certainly not Ludmila Petkova. They know precisely what they're doing, and in fact, they're more obscure than that. They don't. So
it's almost a fervour.
Yes, it's it's the way some people would talk of the Antichrist. That's how they see us. The fact of it is that they don't actually allege tax evasion and tax avoidance. What Moscovici and Petkova are constantly referred to as the Cayman Islands being non-compliant. But they never actually say non-compliant with what. And the reason they can't and don't is because we're not non-compliant with anything. The extraterritorial legislative, regulatory and taxation initiatives of the EU are unlawful and ill-founded. We still have good case law in the common law world.
If that were the case, we could take them to court and prove that. But why is no one doing that?
Which court?
Well, the European Court of Justice.
Good luck in bringing an action against the European Commission in the European Court of Justice. There has been talk about bringing actions, but the problem is the forum. And nor has the Cayman Island government shown any indication that it wishes to do so. If we look at this from the other side of the coin, the Cayman Islands' response has been to kick the can down the road. It's been one of acquiescence.
In fairness, though, that has worked for 30 plus years.
it's a law of diminishing returns.
Mm-hmm.
Now you get to the point where you're not kicking the can down the road, you're kicking it uphill, because the European Union Parliament have said, come clean. They've said what we're actually concerned about is a zero tax rate. So now you're staring at it. I think you can kick the can down the road for so long, but the problem that I want to get to here is that if someone makes unsubstantiated allegations against you, under threat of blacklist or whatsoever, and you acquiesce in your response, what you're actually doing is validating their allegations. And that is the public relations problem the Cayman Islands faces. The great unwashed out there in the world don't actually understand any of these issues. What they know is the EU, a purportedly reputable institution, makes allegations about the Cayman Islands wrongdoing, and the Cayman Islands says, yes, how do we fix it?
But if we didn't attempt to, if you like, fix the problem, there are levers they could pull to almost immediately close us down, whether it be blocking us from the SWIFT system or blocking this, that or the other.
Well, not the SWIFT system, but there is no doubt that there is a threat, but there will remain a threat unless you deal with the unsound nature of the threat. What we haven't done on the world stage is analyze the situation to show the rest of the world at large, EU apart, that there is no strength, no rectitude, no propriety in the EU allegations. Unless you attack the fundamental of the blacklist threat and show it to be ill-founded, you're constantly going to be subjected to it.
If we're using war analogies, it's rather like coming back and saying peace in our time.
Well, any policy of appeasement, yes. Any policy of appeasement, as we've just seen tragically most recently, is doomed to fail if you're dealing with a tyrannical institution. The other point about could they shut us down that shouldn't be ignored in the debate, Simon, is that I wrote the piece I wrote some years ago. When you analyse the volume, or the dollar volume of investors that are situate in the EU who invest in Cayman Islands vehicles, it's less than 5%. And for good reason. The EU have never offered any quid pro quo to any of their threats. They excluded us under the Alternative Investment Fund Management Directive so that we can't passport our securities, market our securities effectively in the EU. So it is in fact a dead zone to us. And furthermore, they've just tightened up their reverse solicitation rules, as you know, which has really further tightened the screw. I mean, I think there are still some private placement exemptions in effect in certain jurisdictions, but nevertheless, those I think will become a thing of the past. So the Cayman Islands can't actually market its securities in the EU.
And there are some incredibly large financial institutions in Europe, lots of large pension funds, and such like, and I guess what you're saying is they can't, in principle, get into Cayman vehicles, but what they have done to get around that is they've opened up UK branches or UK subsidiaries, and then they route their investments through that.
There is no institution that you describe that doesn't have an affiliate in Hong Kong, Singapore, or New York that could not make the investment in a Cayman Island fund.
If it needed to.
If it needed to. Or if it wanted to. And of course, institutions of that sort are yield hounds. I mean, they're looking for the return. If they find a 15% year-to-date, year-on-year Cayman Island fund, they're going to invest in it. They don't need to do
They'll find a solution to get to it.
Yeah, they'll find a solution.
Well, look, we're going to take a short break, but after that we're going to continue this conversation. And perhaps we've talked about the threats from outside. Then we'll talk about how we're responding inside the Cayman community. Welcome back to Money Sense and our conversation on Cayman's future with the ever-provocative Tony Travers. Tony, before the break we had talked about the threat from without, and I think now the important aspect that we should delve into is not necessarily the threat, but the response from within. So is Cayman responding to these threats in a constructive, productive, and sensible manner?
Well, I think you're referring to the regulatory tsunami. I think we've had 177 bits of legislation, regulation.
Which is good for lawyers, isn't it?
Yes, up to a point, and I think you've hit on the fallacy. You have to recognize that the costs of compliance with this additional regulation is coming out of the client's pockets. And there comes a tipping point when Cayman is no longer viable as a result of it. What you really have to establish, and what I think has been lost, because I think certain people in the island have been drinking the FATF Kool-Aid, is that there is no substantive evidence of predicate offences of money laundering in the Cayman Islands. The Monetary Authority is required by its governing statute to be proportionate. We find millions of dollars of fines being suggested now for offences which do not relate to predicate money laundering, but which relate to a regulatory framework designed by someone in Paris to prevent money laundering. But you can't prove the counterfactual. What we know for a fact is we have no evidence of money laundering. If you look at the Solicitors Regulation Authority in the United Kingdom over the last year, they and we're talking now about solicitors in the United Kingdom, and London we know is the hotbed of international integration for laundered money. You find that there were 172 inquiries in relation to breaches of money laundering regulation, in relation to which the aggregate fines were only £160,000.
In the UK.
In the UK. And yet we find, millions of dollars of fines being levied here with no predicate evidence of money laundering.
But that's the solicitors' body in the UK.
Yes.
The FCA has levied big fines on NatWest and others amongst that.
The FCA has levied big fines on National Westminster Bank very recently for actual money laundering. In the National Westminster Bank case, where that bank was fined $256 million, a jeweller in Bradford was routinely on a Friday afternoon depositing $2 million in cash every Friday afternoon in the local branch of the National Westminster Bank. Now, I'm all for fining, putting out of business, doing whatever you want to actual cases of money laundering. What I'm not for, and what Cayman shouldn't be for, is increasing the regulatory burden when no one can actually explain to me how you launder money in the Cayman Islands. Money laundering involves placement, layering, and integration. You tell me, or somebody tell me, how exactly you place money in the Cayman Islands.
So are you suggesting, and I don't want to put words in your mouth here then, that the implementation or the enforcement of the regulatory rules as they exist has perhaps gone a little far?
No, it's gone altogether too far.
Okay.
Altogether too far. And it needs to be reined back, because I don't think it's constitutionally correct, because the Constitution itself requires proportionate regulatory initiatives. So I think it's altogether too far. If you get to the point where you've got to certify the likeness of a passport photograph which has already been certified by the organisation or authority issuing the passport, you've gone too far.
Yeah,
and at no point in any of this regulatory overlay has it ever been suggested there was a predicate money laundering offence. At no point has any law enforcement authority said we have not been able to find the beneficial owner of this Cayman Islands company because a regulatory filing requirement was not complied with. So what I'm actually saying is you really have to take that into account. You have to look at the underlying reality of money laundering in the Cayman Islands, or the absence of it, and fix your regulatory regime in a proportionate manner.
One of the arguments is that one of the requirements to be moved off the grey list, ironically, I think the requirement was to move from the grey list to the white list, but it's gone the wrong way. But anyway, one of the requirements to move from the grey list in a positive direction was to introduce or have a fining regime, so that people would be encouraged to do the right thing and discouraged from doing the wrong thing. So the argument is, sure, let's go out and find a few people, prove that we can, prove that we do, and then at least we'll be off that particular naughty step.
Yeah, but that's a completely distorted approach to money laundering. What you're actually looking for in money laundering is the laundered money. Whether or not you have a regulatory regime that is or is not proportionate and is or is not complied with has been disassociated now from the fundamental it's supposed to eradicate. And look at what's actually happened with the FATF. When these regulations were introduced in the 1990s, I recall being in the room. We were told there would be one due diligence KYC source of funds analysis at the point of entry of the funds into the system, and thereafter you could rely on established banks from recognized jurisdictions. Now we've got a situation where multiple service providers in respect to the same client in the Cayman Islands have to replicate exactly the same information, which is hugely cost ineffective. And you know, the FATF in all these endeavors over the past 25 years have succeeded in allowing international money laundering to go from the $2 trillion number they alleged in 1995 to a $4 trillion number today. And 1% of suspicious activity reports result in an interdiction of funds. 1%. So here you have, to answer your question, a massive body of regulation which is completely and utterly ineffective on the global stage. And we're replicating it.
Do we have a choice to do anything different?
Well, again, it goes back to the issue of the effect of a blacklist, the threat of a blacklist, and if you if you are adopting a policy of acquiescence, then you will end up with precisely the situation we have today.
So where does the fault lie then? Is the fault at the door of the government? Is the fault at the door of the regulators? Where does fault lie in your view?
I wouldn't use the word fault in the analysis. Except to say that the fault is clearly, if there is fault, is clearly with the FATF. Their system doesn't work. It's hopelessly inept.
But how do we counter that?
Well, I'm not sure there's an easy way of countering it, but we haven't endeavoured to.
Right.
Is my point.
So it's a policy issue.
Yes. As a matter of policy, whatever the FATF say they need, we slavishly adhere to. But there is a point where with this additional regulation, of course, it's not just anti-money laundering legislation. You know, we have the wholly unnecessary regulation of private funds now. We have the potential extension of the economic substance regulations to everything that isn't a regulated fund. Again, no one making any coherent argument as to why economic substance regulation should be extended.
So let me ask you that. Let me address that question head on with you, if I can. Why wouldn't it just be easier for Cayman to say, what the EU says they hate about us is that we don't have tax? Why don't we just introduce a tax rate and exempt international businesses from it?
Oh, because because that misses the point of tax neutrality. The entire mechanism that underlies the success of the Cayman's financial services industry is based on tax neutrality. If you take that away...
But the UK has taxation, but funds are exempt in the UK, so you can exempt those sorts of things.
Well, if you want to exempt the funds industry, you would need to exempt the funds industry, obviously, but I'm not sure of the desirability of introducing corporation acts here, because you'd lose your corporations. Why would you want to be here? It's as simple as that. Cayman Island entities, the concept of tax neutrality, remember, says that Cayman Island entities pay tax in the jurisdiction where they're making profits, and their investors pay tax, shareholders, limited partners, in the jurisdiction of their residence or domicile when distributions are made to them. So the entire concept of the Cayman Islands works on the basis you don't introduce an additional layer of taxation here, and you drive a nail through the heart of that if you seek to introduce taxation here. which is, of course, what the OECD are endeavouring to do with what they call global minimum tax.
Because that would, as you say, drive that nail proverbially through.
It's where they want to go.
But it's an easy way to achieve the outcome they want.
It's an easier way to achieve the outcome if you obfuscate what the intentions really are, which is what they've done.
Until recently, you're saying?
Unless and until you actually read it.
Yeah, you said before, I think, that and not one parliamentarian doesn't make a policy, but it's a shared view that the goal is to close down places they just don't for historical reasons, don't like.
That's right. I mean, that's absolutely right. I mean, the first thing you need to know about global minimum tax is it isn't a global minimum tax. The OECD is simply calling it that because that's their end game. They want to be the global body applying taxation.
I think, if I'm not mistaken, taxation was introduced, I don't know if it was the US or UK, on a temporary basis. And I don't think that's necessarily that legislation.
It was probably introduced around 1865 again in the United Kingdom, yeah.
So those things that are temporary often have a more permanent nature.
Well, we know. Yes, exactly right. We know for a fact that if you look at any graph of taxation, when introduced, it goes from the bottom left-hand corner to the top right, which is the problem the European Union have at the moment. They cannot possibly pay for their welfare programs without dramatically increasing tax on a federal basis across every European Union jurisdiction. And you're talking, to make the numbers work in Europe, about a tax rate of 80%.
I guess the ironic thing is, were Cayman, and we'll end with this particular note, I suppose, but were Cayman to introduce a taxation rate which took away all the funds industry, it probably would make not a cent of difference to the taxation received in European Union countries, because those funds would simply relocate to an Ireland or Luxembourg arrangement, which was itself tax neutral.
Well, possibly that, but there would have to be exemption because they'd be triple taxed, and that isn't a part of anybody's plan.
Yeah. So destroying Cayman wouldn't actually have the long-term gain of.
That's the fallacy of the European Union approach. That the European Union actually think that if you take the Cayman Islands out of the equation, the $9 trillion goes back to Europe, which it didn't come from in the first place.
Quite. Okay, well, with that, Tony, we are sadly at the end of our conversation. You never disappoint in terms of your mood and your red-hot caffeine-injected burst of thought provocation. I think I may need a lie down now, but thank you very much for your time,
You're welcome.
your perspective and your good humour in joining us on Money Sense.
Thank you.